Welcome back. We can take another look at the equity and fixed income markets today. Yesterday we had a pretty big sell-off to the downside. It looks like the weakness is continuing to some extent today. Now, the chart in front of us, the blue dots represent the S&P 500. The red dots represent the VIX, the Volatility Index. The Volatility Index, also known as a fear gauge, moves in opposite directions of the stock market. Traders tend to buy options as a hedge or any type of insurance when equity markets get weak. So when stocks go down, the VIX, the volatility index, goes up. But also, this also holds true in terms of the Nasdaq 100 volatility index, which is essentially the same thing. The VIX is a volatility index based on the options on the S&P 500. The Nasdaq 100 volatility index is obviously based on the Nasdaq 100. But in both cases, we see after a long, steady trend to the downside with a very strong correlation, both fear indices move back to the upside. Now, taking a closer look, we see the Nasdaq 100 volatility index sharp spike to the upside off the lower Bollinger Band, crossing back above the 20 simple moving average. This also holds true for the VIX, the volatility index. Now, taking a look at exactly how big this move was yesterday, because in terms of these fear indices, it was actually quite significant. The Nasdaq 100 volatility index yesterday registered a level of 29.65. Now, over the past 10 periods, which are 10 daily trading days, I should say, this is the highest level, as well as the VIX registering a 23.8. It's the highest level we've seen in quite a while as the Nasdaq registers a new low. Interesting, the S&P 500 did not register a lower low for the past 10 periods. However, the Nasdaq did. Now, with that said, when we're talking about equities, we should also consider the bond market because they tend to work sometimes very closely together. And sometimes, interesting, there's divergences between the two. Specifically on the bottom left-hand corner, we have the individual bond yields. A 30-year bond has a maturity, or a 30-year maturity has an interest rate of 3.24%. The 20-year is at 3.48%, etc. Now, what we want to look at is the spread between the two. So the 30 minus the 20 gives us a negative interest rate of 0.24 or negative 24 basis points. Again, that's because the 30-year maturity bond pays a 3.24% yield and the 20-year pays a 3.48. The difference between the two is negative 0.24. The spread between the 20 and the 10 is 0.45. It's 3.48 on the 20-year minus 3.03 on the 10-year. And then the 10 to the 7 is a negative 0.09, and moving on down the road. Now, what we can do is we can classify bonds loosely into long-term, medium-term, or short-term. So, for example, the blue line below, first of all, this big orange area chart is the S&P 500. This is going back to March, April of this past year. So after a big move to the downside ending in June, we've seen a progressive move higher, of course, excluding yesterday and today's weakness. Now, the blue line represents the spreads, the sum of the spreads between the long-term bonds, which I like to think of as the 30-year, the 20-year, the 10-year. So the difference between the 30-year and the 20-year plus the spread between the 20 and the 10. Okay, so those spreads add up to the blue line. The red line represents the medium-term bond maturities and the spreads between those respective bonds. So we're talking about the 7-year, 5-year, and 3-year. And then the green line represents the short-term bonds, which is 2-year and any maturities less than that, 1 year, 6 months, etc. Interesting, though. Notice how over the long term, over the past, let's say, 5 months or so, as equity markets have moved very much to the downside, the long-term and medium-term bond maturities, the spreads between those bonds have very much contracted, whereas the spreads have widened between the shorter-term bonds. When equity markets go down, there's fear in the economy. And as a result, traders tend to move money into shorter term bonds, which is why we see the short term bond yields, the spreads in those yields really tend to widen when the green line is much higher than the red and the blue. Notice as equity markets hit a low in June, the short term, the long term bonds, the blue line crossed above the red line right over here. This is right about June 30th. Now, what happened as some confidence came back to the equity markets, the spreads, relatively speaking, started to widen on the long term bonds a little bit more so than the medium term bonds. And as we can see, as equity markets have continued to rally from late June all the way through, last week, we saw the spread between long-term and medium-term bonds continue to widen as the spread on the short-term bonds, the green line, really came to the downside. So what does this tell us? Moving forward, if, for example, we expect stocks to continue higher, let's say they go to all-time highs or reapproach those 52-week highs, it would be logical to assume that the long-term bonds, the blue line, the spreads in those long-term bonds would continue to move higher. Maybe to a lesser extent, the short, medium-term bonds, the red line, would also continue to move higher, and the green line would continue lower because capital would be moving out of short-term bonds and taking more of a risk in the long-term bonds and the medium-term bonds. However, conversely, if we expect yesterday's weakness and today's weakness in the equity markets continue, let's say we expect that stocks to go back down to their June lows, maybe even lower than that, I would expect to see the short-term bond yields continue to move higher, maybe even approach new highs, and capital continue to fly out of the long-term bonds and the medium-term bonds. In fact, if stocks really make new lows, I would even expect the blue line to cross back below the red line, meaning I would expect the spreads in the long-term bond maturities really to contract, and the long term much more so than the medium term. So this allows us to use the bond market as a secondary tool of confirmation if we're trying to gauge, if stocks are going to go up, go down, or perhaps maybe stay in the trading range. If there's a trading range in these lines, I wouldn't expect them to move very much at all. However, with that said, considering that, again, the fear indices, the VIX and the Nasdaq 100 Volatility Index really had a big spike up, at least the highest readings we've seen in the past 10 trading days or so, I would suspect that maybe this is something that we're going to see more of a follow through, at least until the VIX reaches that inflection point when there's so much fear in the market that traders decide it's time to take a risk. Personally, I don't think we're there yet, but only time will tell. At least that's what the numbers suggest at this point. Hope this has been helpful. We'll see you again soon.